When you look at the latest Brexit developments, we understand there's a vote, there could not be a vote. Are we looking at a possible extension? Are we looking at a deal? What are the implications for monetary policy?
Well, there's many different paths, as your question indicates, and obviously we will see which path is chosen and then react accordingly. The good news is that there is an agreement between the UK and the European Union, and that as a consequence of that agreement, if it's adopted, would be that there would be a transition, an orderly transition to a new economic relationship. And we have been saying, the Bank of England's been saying from day one after the referendum, after the decision of the people of the United Kingdom to move to a new economic relationship, broader relationship with the EU, that it was important to have a transition to that relationship, and that's what this deal would deliver if it is adopted.
But so what does that actually mean for rates? Could a rate hike be back on the table?
It's hard to distill it down to one thing. It depends the nature of adoption, the time frame in which it happens. I mean, there are lots of potential paths, but transition's better than jumping, clearly better than the alternative, and the alternative is a no-deal Brexit at the end of this month. In general, what we have seen in the UK, and I would like to generalize the point, but I'll stick with the UK, is that this entrenched uncertainty about trade relationships, and this is the tightest trade relationship in the world between the UK and the rest of the EU at present, this entrenched uncertainty about it is having a consequence for business investment. We think business investment, the level is about 25% below where it otherwise would have been post-referendum. Now, if this is adopted, it will remove much of that uncertainty. We would expect a rebound in some of that investment. It won't all come back, obviously, because we don't know the exact nature of the future relationship. The future relationship is still to be negotiated, but we do know that the prospect of an orderly transition is put in place, and we do know the broad contours. In that environment, you would expect, all things being equal, and they're not always equal, but all things being equal, the economy to pick up from what has been quite a subdued pace, and that makes monetary policy a little more interesting.
And so that would be including interest rate hikes?
Not necessarily. I'm not going to pre-commit. And there's a lot of contingencies there. We also we're sitting here, and this is why I wanted to generalize the point. We're sitting here at the IMF meetings, and as you know, the characterization of the fund of the global economy is precarious, that the momentum in the global economy is precarious. Now, that's new. That has built up over the course of the last 18 months. Why is it built up? The principal reason is global trade tensions, particularly tensions between the United States and China, the United States and Europe. And as a consequence of that is you're seeing globally now what we have been seeing in the UK. So we have to take that into account. How much momentum is there in the global economy? Are we stabilizing now? Is that about to pick up? So you take all these factors into account and make the rate decision at the appointed time.
We're having a conversation with Mark Carney, the governor of the Bank of England, at the IMF World Bank meetings. Is there a stark division on the MPC on how you would deal with a no-deal Brexit?
No.
And so you would deal with it with...
Well, there is not a division in terms of the overall approach. The approach is guided by achieving the inflation target, the 2% inflation target, using the flexibility we have under our remit, our mandate, to adjust the time frame over which we would return inflation to target, likely from above in the event of a no-deal Brexit because of currency impacts on inflation. But the exact judgments about what no deal does to the supply capacity of the economy, particularly, different individuals will form their own judgments on that. These are very difficult judgments to be, so there may be a range of views around that. But overall monetary strategy, no, there's not a division, and we would address it if we had to. I would remind, though, that it's not just about monetary policy in that event. We have many other tools, so-called macro-prudential tools, and the Financial Policy Committee has signaled that it would be expected to move quickly.
But if there's a no-deal Brexit, how quickly could you react to a no-deal?
Well, we would react in the normal time frame. We'd be deliberate about it. There's not. Look, in terms of the financial, we have reacted to the prospect of a no-deal Brexit over the course of the last 3 years. We have put the core of the financial system in a position that it is ready for any potential outcome
extension. So would you be in favor for a 3-month extension or a 9-month extension? And again, what does that mean for uncertainty?
Well, look, it's not our responsibility. Right. The question on the table, and parliamentarians are taking their responsibilities extremely seriously and debating it, is that, as you would expect, is to determine whether or not to adopt this deal, and we'll find out relatively short order. We are prepared for all eventualities.
We've seen quite a lot of volatility on pound.
Obviously, it's absolutely. This drives the currency. It drives economic prospects in the medium term. These are quite different paths to move to WTO trading terms overnight, or to have a very smooth adjustment to what compared to WTO would be a much deeper trading relationship.
Are you surprised
and
by
of course
that volatility?
That's it. Not at all. We've been saying, look, at points we were criticized because we observed that we would expect a fair bit of volatility in the pound because of these. But it's.
You also called it an emerging market.
Well, no, I observed that the level of volatility, which you can type up on your Bloomberg screen and verify that I'm right. Somebody's probably doing it right now. But the level of vol on sterling, the major pairs for sterling cable and others, is the same level of vol as major emerging market crosses. That's a fact, and that has been a fact for a while. But that's because big economic issues are being decided almost as we speak.
We're in conversation with Mark Carney, the Bank of England governor. We're talking, of course, about Brexit, about pound volatility.
Of course we're talking about that.
If you talk about emerging markets, is there an emerging market currency that you look to try and see how you could stabilize pound?
No. How's that for a short answer? No. Look, this is a unique situation. It's the deepest, most integrated economic relationship in the world, right, between countries, and there is going to be a substantial change to the level of integration, and therefore the financial markets, and it's most immediately expressed in sterling, but we see it in the gilt curve, and we see it in UK-focused equities, we see it in UK commercial real estate. Assets are repriced.
Yep.
You see it across the board because these are big. It is a wide range of potential economic outcomes. There's more positive developments in recent days and weeks, and there's a prospect again. Let me underscore one important point. It's not just the financial sector is ready for Brexit, but this is one of the most flexible economies in the world. Balance sheets are in good shape, household balance sheets, corporate balance sheets in good shape, financial system in good shape. With transition, this economy will adjust.
But how difficult is it to do forecasts in this? Should you just
it's difficult.
Forecasts?
One is doing scenarios as opposed to forecasts because there are very different scenarios whether we have a smooth transition to a deeper relationship versus whether we have no deal. Those are, and so you can't just take those two scenarios and do the average of them and say that's what's going to happen. No, these are bimodal outcomes.
If there's an extension, how much is the global economy going to weigh on this if we don't have a trade deal?
Well, the global economy is going to weigh on this regardless,
no
right?
Right.
Again, also one of the most open economies in the world. It's no secret that one of the jurisdictions that's been most affected by global weakness is Europe, and the heartland of Europe, Germany in particular. Your next guest can talk to that, I'm sure. Now, we're not as pessimistic as some are about those prospects, but it is having an effect on the margin on the UK, as you would expect. And the big question at these meetings is, are we stabilizing? Is the global economy as a whole stabilizing? And is that prospect of picking up next year there? Is macro policy right globally? Is there enough monetary stimulus? Is fiscal going to come in behind? And above it all, though, is what should not be an irreducible uncertainty, but is starting to feel like one, is around trade. And look, you can't lean against that. You can't substitute for it. That's what you've seen in the UK, the orders of magnitude of the effect. The UK may have led the world into this. We may be leading the world out of this if this goes forward.
Would you stay on as governor of the Bank of England if you were asked to do so?
What I've committed to do is to stay on, and I have. in order to ensure there's a smooth transition to my successor, and candidly as well, and I've been clear about this, is kind of to put myself where my mouth has been. In other words, to be in this seat at this critical time. So whatever happens, whatever path we're forward, the preparations that we put in place, it's all fine and good for me to say, don't worry, the financial system's ready and I'm off back to Canada and good luck. No, I'm here at this moment in order to do that. And then the next phase is, a decision will be made, and then,
but if you get
then the government. No, look, the government's got plenty of time to choose a successor. There's many qualified candidates. They will make a decision at the appropriate time. Not surprisingly.
Are you
not
telling
surprisingly.
Me we'll see?
Well, it will happen in due course, and I recall that highly successful president of the European Central Bank was selected weeks before he took office. Mario Draghi came in weeks before he took office. This is, these institutions are ready.
You talked a lot about crypto here. Where will the biggest shift in cryptocurrencies come from, or the biggest disruption?
To be candid, we didn't talk
central banks.
In where? In central
the biggest disruption for cryptocurrencies.
Well, first off, we don't talk a lot about crypto. Like that end, that fringe. I'm sorry, now I'm going to get a lot of hate, but that fringe of the sector, discussions on stable coins, really discussions about the future of the payment system. Like in the end, the core, we're going to preserve monetary sovereignty. The question is, where do you put the boundary between the public sector money, that's us, the core public sector infrastructure, central bank infrastructure, and access to it, again, that's us. But you want to do it in a way, and we firmly believe this in Bank of England, you want to do it in a way that allows for private innovation. There's absolutely a revolution in payments that can benefit all our citizens, can make the world much a more stable place. It can create huge opportunities for smaller businesses, great financial inclusion, and it can just shift. It can save people hundreds of millions of pounds per year in the UK. So we're interested in advancing that, but on our terms. And core point, this is not going to be social media. This is not going to be something happens and then the authorities run around after the fact and try to figure out how to regulate. No, we will gate this. We will gate these developments. We'll draw the right lines between where the public sector starts and stops. And it starts and stops it starts at money. Where beyond that it stops in the payment system remains to be determined.